Over the last week, I've gone through hundreds of comments across Labor Party, Liberal Party, investor groups, finance pages, and mainstream media articles discussing the proposed changes to negative gearing and capital gains tax. And honestly, the most interesting part hasn't been the politics, it's been the behavior. Because whether people support these reforms or completely oppose them, one thing is becoming very clear. Investor behavior in Australia is about to change, and property markets are driven by behavior, not headlines, not election slogans, not media outrage, behavior. Because when governments change incentives, capital moves, investors adapt, markets reposition. And after reading through thousands of reactions, I think there are 5 major behavioral shifts that are now likely to happen in the Australian property market. So in this video, I want to remove the politics entirely and focus purely on investor psychology, incentives, and the likely second order effects these reforms could have on the market over the next few years. Now, before we start, I want to make something very clear. This is not about whether the reforms are morally right or morally wrong. Some people believe these changes improve fairness and affordability. Others believe they punish aspiration and investment. That's not what this video is about. This video is about understanding how investors are likely to respond. Because regardless of ideology, markets adapt to incentives. And that's where things become interesting. Now, the first major behavioral shift I think we're likely to see is a significant increase in investor demand toward new builds, house and land packages, and off-the-plan property. And this was probably the single biggest theme coming through the commentary and investor reactions. Because under the proposed reforms, negative gearing benefits would largely remain available for newly constructed properties. Meaning, many investors now feel they may be pushed towards new builds simply to preserve the tax advantages they've traditionally relied upon. Because here's the important distinction. The sentiment isn't, these are the best investments. The sentiment is, these may become the only residential investments that still preserve the tax benefits. And that distinction matters enormously because historically, when investors buy purely for tax outcomes, they often ignore asset quality, they ignore scarcity, they ignore owner-occupier demand, and they ignore long-term capital growth fundamentals. Instead, they chase deductions, and that can create some very dangerous behavior in the market. Because if thousands of investors suddenly flood into similar stock, particularly house and land estates or apartment developments, you can end up with oversupply issues, weaker long-term growth, and assets that struggle to outperform once the initial tax incentives fade away. And honestly, this concern came up repeatedly in the commentary about off-the-plan apartments. They're cautious because construction defects, developer insolvencies, oversupply risk, and lack of scarcity are still very real concerns. And I think this is one of the biggest misunderstandings in property investing generally. Tax benefits can improve cash flow, but they cannot manufacture scarcity. And scarcity is one of the biggest drivers of long-term capital growth. Now, the second major behavioral shift I think we're likely to see is that more sophisticated investors become even more selective. Another very consistent theme throughout the commentary and reactions, that the more experienced investors don't appear excited, they appear cautious. Because sophisticated investors understand something important. Good investments are rarely created by tax policy alone. They're created by fundamentals: supply, demand, scarcity, land value, infrastructure, employment, owner-occupier appeal. These are the things that drive long-term performance. And many experienced investors seem increasingly concerned that these reforms may push inexperienced investors towards lower quality assets simply because the tax incentives remain available there. Now, this doesn't mean all new builds are bad investments. Absolutely not. There are quality opportunities within new construction markets. Investors may need to become much more selective because when incentives distort behavior, people often stop asking, is this a good asset? And they start asking, how much can I deduct? When those are two very different questions. Now, the third major behavioral shift, and in my opinion, one of the most important, is that investors may hold on to established property for much longer. And I think this is the second order effect that very few people are talking about. Because if capital gains tax concessions become less attractive and existing investors are grandfathered into the old rules, think about it logically. If you own a quality established asset and your current tax treatment is more favorable than what future investors may receive, why would you sell? In many cases, you probably wouldn't. You'd hold, you'd refinance, you'd restructure, but you'd likely avoid triggering a taxable event unless absolutely necessary. Behavior like that, the amount of established housing supply entering the market actually decreases. Now, this is where markets become extremely interesting because these reforms are are designed to improve affordability and redirect investment towards supply creation. But ironically, they may also reduce the turnover of existing housing stock, meaning fewer established homes become available. And if population growth continues while existing supply tightens, that can place upward pressure on prices. Again, this comes back to incentives. Governments don't just change tax policy, they change behavior, and behavior changes markets. Now, the fourth behavioral shift I think we're likely to see is that some investors begin looking beyond residential property altogether. And this was another major theme coming through commentary and investor sentiment, because capital rarely disappears, it simply moves. If incentives reduce in one area, investors start exploring alternatives. And increasingly, there appears to be growing interest in commercial property, self-managed super funds, positively geared assets, shares, business ownership, and alternative structures, particularly among more experienced investors and higher net worth individuals. Now, this doesn't mean residential property suddenly becomes unattractive, but it does mean investors may become less emotionally attached to residential real estate as the default path to wealth creation. And honestly, this may be one of the most significant long-term shifts of all, because for decades in Australia, property has been heavily incentivized relative to many other asset classes. And if those incentives begin changing, capital allocation may gradually shift with it. Now, the fifth and final behavioral shift I think we're likely to see is continued pressure on rents. And this was one of the most repeated themes across investor commentary. This is simply about economic behavior, because if investors lose deductions, holding costs effectively increase. And when holding costs increase, many investors attempt to recover those costs through stronger rental returns. Now, obviously, markets ultimately determine what tenants can afford to pay, but if rental supply remains constrained while investor participation in established housing decreases, that could put additional pressure on rental markets over time, particularly in established suburbs where new housing supply is already very limited. And this is where the housing conversation becomes very complicated, because housing markets are deeply interconnected. You can't change one incentive without affecting multiple parts of the system simultaneously. Investor demand changes, rental supply changes, construction demand changes, capital flows change, and often the second order effects are very different to the original intention. Now, stepping back from all of this, I think the most important thing investors need to understand is this: markets are adaptive and capital always responds to incentives. That's true in shares, it's true in business, and it's true in property. Now, personally, after reviewing all the commentary, investor reactions, and broader market sentiment, I don't think these reforms will stop people investing. I think they'll change where, how, and why people invest. And that distinction matters, because the Australian property market is unlikely to suddenly collapse because of these reforms. But investor behavior may become very different over the next decade, more selective, more tax conscious, more focused on structure, and potentially more focused on scarcity and quality than ever before. Now, whether these reforms ultimately improve affordability, increase rents, reshape investor demand, or redirect capital towards new construction, we'll have to wait and see. But one thing is very clear: the market is already beginning to reposition psychologically, and often that behavioral shift begins long before legislation is fully implemented. Now, I genuinely love to hear your thoughts in the comments below. Do you think these reforms will improve the market long term, or do you think they'll simply change investor behavior in ways policymakers may not fully expect? And if you want help understanding how to identify investment grade opportunities, regardless of where policy moves next, that's exactly what we help clients do. We focus on long-term supply and demand fundamentals, not hype. So if you'd like help putting together a clear property investment strategy, you can book in an initial strategy consultation using the link below. Otherwise, if you found this video valuable, make sure you give it a like and subscribe, and I'll see you in the next video. Thanks again for watching.